right, so let's take a shot around the world. Holler out from where you're at and what time it's at. West Coast, East Coast. I know I've got some people around the globe up in here, and there is Mr. Bob Lang. He is our next speaker, and we're going to welcome him real quick. Let me tell you a little bit about Bob. Bob Lang is a private trader in stocks and options, and he serves actually as one of Jim Cramer's go-to technical experts on Mad Money, and he writes for TheStreet.com. I know a lot of y'all probably go and check and see what Cramer's saying and read up on what's happening on the street, so there's a couple places that you can catch him. I spoke to him earlier this evening, and he said that Cramer actually uses his charts and his technicals on Mad Money about once a month, and I went, whoop, whoop. He's got the inside over there. So there you go, people. We got a rock star among us. He's going to talk about stocks, his chart setups, some psychology, which we all need desperately when it comes to trading, and you know you do, and the option market. So, ladies and gentlemen, please welcome TradingPub's 24-hour trade-a-thon next guest this evening, and that is Mr. Bob Lang. All right, we're getting Bob to check in right now. He's doing a couple audio tests. Y'all just hang tight until we get the sound to come in clear. Everybody just hang on.
Okay, how do I sound? Am I coming in okay?
All right, sounds like we got you, Bob.
Okay,
Take it away.
Sorry about that, Jeanette. Well, welcome everyone. I'm thrilled to be here with all of you tonight, and it's going to be looking forward to a really fun session with you guys here for about an hour and 40 minutes. So thank you very much, Morgan, and thank you, Jeanette, for having me here with all of you tonight. And on the webpage, it said I was to be talking about stocks, and of course, as you know from my options website, I'm most exclusively doing options. But what I wanted to share with all of you tonight is a little sampling of a lot of different important areas. And first, we'll cover some areas about trading, about stocks, mostly directed towards technical analysis and charting. This is really where I get my ideas coming from. And it always starts with the charts. It always starts with the technicals for me. Okay, and then once I find the setup and find the idea that I want to get into, then what I will do is go to the options montage, look for the right price, look for the right strike, the right time, and so forth, and then build it that way. But it always starts with the charts and always starts with the technical. So we'll talk a little bit about that. We'll talk a little bit about options trading and some trading options the smart way. I think a lot of you people out there can get some benefit from learning about the basics and why to choose options and maybe a couple of different types of strategies. I want to talk a little bit about market psychology and the effects of that as well too, and we'll discuss a little bit about volatility too. So we have a lot to cover in this period of time, and I know I'm grateful that Jeanette's giving me a little bit of extra time here to share with you. So without further ado, let's go ahead and I'm going to go ahead and share my desktop with you. Let's see here. Hang on a minute. Install here. Okay. So you're going to see my charts here in just a minute.
Everybody just be patient with us for just a second here. Bob's getting his desktop sharing loaded up. And sometimes, you know, as with anything else, technology, sometimes she don't do what we want her to do. Like I said, first world problems. Oh, there you
I'm back, Jeanette. I'm not sure what happened there, but I tried to get that. Maybe I should just I could download the slideshow or the slides. What do you think? Would that be better to do?
Oh, certainly. The upload will take just a hair, so you can go ahead and start doing that now, and maybe just share a little bit about what you're going to talk about.
Sounds good. Sorry about that, everyone. Let's see here. So so basically, okay, I'm going to be we're going to talk about options here. I'm going to bring my options one up first, and then we'll come up with bring up some charts. Let's see here.
You know, Bob, back in the day when I ran a chat room, I always had a bunch of music loaded up. So when we had problems like this, I could say, all right, guys, we're going to play some 70s music. Y'all give me a second. I got to figure out what the heck's wrong with my technology. I need everybody to reboot.
Okay, I'm back here, and I apologize, keep getting booted over here, but let's keep going over here, Jeanette. So let me go ahead and hit my slideshow here. Let's see here.
No worries, Bob. When we post your audio for people to watch later, we'll say, y'all just skip up to the 18-minute mark. We had technical difficulty.
Okay. Let's see here. Okay, you know what? What I'm going to do is I'm going to go ahead and start talking about. I'm going to talk off my slides here, and I apologize. What I'm going to do is this. I'm going to talk off my slides, Jeanette. For some reason, I'm having a little bit of difficulty loading these things up.
But shoot them over to me on Skype or email them to me, and I'll upload them for you. Okay. And then I'll play them when they're.
Perfect. Okay. All right. Hang on one second here.
Hey Ben, welcome to the show. We're just having a little bit of technical difficulty here. We're trying to load up some slides, and our speaker Bob Lang's having some issues on his end. So we're just working through it together as a team, right?
Yep. What did everybody? Let me ask a couple of questions out there. Let's get some comments. What did everybody think about the breakage in the market this afternoon that happened for about 3 hours of non-trading in the Nasdaq? What did everybody think about that? Was everybody worried and thinking about a flash crash coming? Did you get any feedback from that earlier today, Jeanette?
Yeah, it was the talk of the town all day long. I was at Morgan's when it was happening, and it was a big joke. It was like we were kidding about the fact that we caused the Nasdaq to shut down so we could get people to come in the webinar and listen to our speakers.
Well, there you go. That's right. Exactly right. So so what in essence what did they what was the reaction? Were people worried, or they were scared? Did they think a flash crash was coming, or what was the general consensus there?
I think what it all comes down to is that everybody's just just tired of the HFTs and feeling very manipulated, and you know, I mean, it's just like anything else. The first time I witnessed a situation like that was when the Twin Towers were hit in 2011 and the market stopped trading. Like, I was literally in a group full of people, a room full of people that were trading. Everybody was long. It was early in the morning, and for us in Mobile, it was right around 7:30 in the morning, and then there was obviously a break in the market. And if you're a tape reader like I am, you can look at the market and you can just see. You don't even have to know that there's news out there. You look at it and you go, okay, there's news. That's not people moving that. That's news moving that. And then it was very clear within a matter of minutes that we had a problem. And then they shut the whole thing down, and there was just sheer panic among us then, because it was a national crisis for us, not just wondering what's going on in the background with a bunch of computers and people manipulating the market. And I think everybody, like I said, that's the first time I ever had a situation where I saw huge moves in the market very quickly, and then they shut things down, and you're in positions and you go, what does this mean? Where's my money going? So I'm sure there's a lot of panic. I'm sure there's a lot of fear, and I think it makes people apprehensive for days, maybe even weeks, about getting back in, which really, my opinion of that is you have to just treat every day like a new day. I mean, it's like a horse, when you fall off, you got to get back on immediately, or you won't, and that fear will kill your ability to make money in the markets. So that's just how I view it, and I think it's how a lot of people view it.
I tend to agree, and but the problem here is that it becomes a confidence issue, right? I think a lot of people out there are going to have their confidence shaken. Look, by and large, you've got 600 people in the room here. I would gather at least 550 of them, more than 90% of them, don't trust this market, right? I mean, if you had to ask everyone, raise your hand in the room here if you don't trust this market. I would tell you 90% of them don't trust it. Right, with in fact, look right now. Look at the comments. Most of these people don't. They trust their system, but most people don't trust the market. So it's another black mark towards confidence and lack of confidence here. And it's a shame, because here we are in 2013. We're supposed to be the epitome of the rest of the world. And we're supposed to be showing off that we're the best ones out there. And when you have glitches like this, and you got trillions of dollars of market value in the hands of computers and that sort of stuff, it becomes a very scary and situation, doesn't it?
Yeah, I mean, I love it when I watched one of Morgan's webinars recently, and in his disclaimer that he puts up at the beginning, he says he cannot either confirm nor deny that the NSA is watching. And it was like a ha-ha, but it was also like reality, I mean, here we are. They made headlines on USA today even, so it's
so somebody asked me, as an options trader, how did I react to the glitch? And that's Brad asked me this question. I'm looking at it, and I see, that's a good question. And frankly, I kind of rolled my eyes a little bit, first of all, and then I thought to myself, I said, wow, it's certainly a good thing that this wasn't Friday, because I've got stuff that's expiring tomorrow. Can you imagine? I mean, I'd be, I'd actually be, I would have had a panic attack if it was tomorrow, especially if I couldn't close positions. I did have a situation one time a couple of years ago. I trade through TD Ameritrade Thinkorswim, where it was an expiration Friday, and I had some positions that I needed to close on that Friday that were deep in the money, and it was like 20 to 25 minutes into the trading day on that Friday. The platform shut down, and and all the trading just went virtually closed. Everything went dark, and I was calling them up frantically, saying, "What am I going to do? What am I going to do?" I got these things closing, and they kept telling me there's nothing we could do, and that really wasn't the right answer for me. And fortunately, a few hours later, they got everything up and running again. But you can imagine what a nightmare that would have been. Okay, so Jeanette, thank you so much for putting up the slides here for me. And you can see this is a little older presentation I did earlier this year, and it's called Trading Options the Smart Way. I've got two presentations here I'm going to share with you guys. This one is Trading Options the Smart Way, and it gives a little bit of basics about options trading. And then the next slide, or the next presentation I'll give you, is a little bit more about options trading as well too. And again, forgive me about not being able to bring up the charts and so forth. But maybe while I'm talking here, Jeanette might be able to figure out a way to help me get myself to share my desktop with you. But in any event, option trading boot camp. And just, I know I'm not sure of the background of all of you in the room here, but let's just start from a point where we're at ground zero here, okay? And simply put, long call options, you basically, if you're a buyer of long call options, you're profiting when the stock rises. If you're long put options, you're profiting when the stock declines. Time is certainly a factor. When you're a buyer of options, time decay is against you. Time is your enemy. So simply put, what moves options? And the hint, it really is, you have to understand something, it's the stock, right? And this is where I talked to earlier today, saying that when I first got started, I start with the technicals. I start with the chart first, and then I move into the options, okay? So simply put, what moves options? It's acceleration of the stock, its momentum, its velocity, good volume, and timing. I'm looking for stocks that are going to make a really, really fast move in a short period of time, right? Because that time decay is the thing that I need to overcome to have a successful options trade. Now, some people out there like to go for the little nibbles and chew on a few nice wins, a few pennies for their option trades. That's great. That's not my ammo. I'm a big game hunter. They call me the big game hunter because I'm looking for large wins. I'm here to trade dollars. I'm not here to trade pennies or cents. Nothing wrong with that. That's a good approach. You can do it consistently. But what I'm looking to do is I want to get into a trade at, say, $1.50, $1.75 and sell it at 3. Okay? I want to buy an option at 4 or 5 and sell it at 8. Okay? So that's the way I do it. And frankly, you have to have a particular style and be willing to wait and be patient for that stock to make that move. And that's why I start with the charts. I always start with the technicals, I start with the charts, and then I move into the options, okay? So timing. It seems to be where everyone gets it wrong. So learning the basics. You want to be able to buy the right option. You want to be able to buy the right strike in the right month, right? I've had oftentimes where my option selection is just dreadful. I mean, I don't get it right. I'm correct in my read on the chart, but I'm not correct in the selection of the option that I make, and that's a correctable problem, because all you have to do is take a little bit more time or go a little bit deeper on the money on that particular issue, right? When to sell your option. Selling is I've written an ebook about it. It's called The Art of Selling. And if you'd like a copy of it, it's free. Shoot me an email at bob@explosiveoptions.net. It's not a selling thing. It's a great informational tool to talk with you about selling. Selling is the most liberating experience you will ever find. And it's the hardest thing for people to do. And you ask yourself, how many times have you been in a situation where you were wearing cement shoes, right? You got yourself stuck in the mud here, and you can't get out. What do you do? You don't know what to do, right? Because you're stuck, you don't know what to do. And oftentimes it's because we got into a bad situation, something occurred where I didn't have you got into a trade and things went, it was the bad news, maybe there was a bad earnings report, maybe something went against you and you don't know what to do, okay? And you're sitting there with a loss. I've been sitting there with 70, 80% loss. I'm twiddling my thumbs, and what do I do? What do I do? And the worst thing that I feel, I don't know about you, but the worst feeling that I ever have is when every morning when I come open up my training computer and I get things ready to fired up, ready to go, and I got to look at that loser day after day after day. Oh, it's the most disheartening feeling, because I get started with a fresh new approach every single day, something new every single day, right? And I got to look at that. I got to look at that loser that I got into every single day. You know what? Just cut it out. It's like a virus. It's like cancer in your body, in your account, right? Just cut it out. Get rid of it and move on. Reducing volatility to maximize your profit potential, and then finally, being able to think out of the box. Don't think like everyone else. Just be different. Do something different that works best for you. So when we talk about options, why do we choose options? I like the options because it gives you an enormous amount of leverage. And what is this leverage that we're talking about? Well, simply put, let's say you wanted to buy 1,000 shares of Apple. Okay, what is Apple? $500? You got $500,000 sitting around? Well, actually, if you want to margin it up, you only need $250,000, right? But does everybody have that kind of? If you want to buy 1,000 shares of it, because you really want to make a dent and make a move, does everybody have $500,000 sitting around? I don't think so. But you could buy 10 call options, which actually is like controlling 1,000 shares of Apple, and you can certainly buy those 10 contracts, whether it's puts or calls, for a significantly less amount of money than you would having to buy 1,000 shares of the stock. So, in fact, I can give you an example of what happened to me last week. And the type of returns you can get in Apple or any other any option derivative for that matter is incredible. Okay, if you're on the right side and you got the timing in your favor here, you can make a killing. I'll give you an example. Last week, in some accounts I'm in, these 480 Apple calls on Monday, right? And I decided to pick some up towards the end of the day. Again, it was a week ago Monday, and these were expiring at the end of the week. So they were somewhat cheap. Apple wasn't doing a whole heck of a lot on that Monday, and towards the end of the day, and I decided to pick up some 480 calls. So they started about 89, 90 cents, right? 90. Then I picked up a little bit more, went down a little bit, picked up about 84, 83 cents. So I'm sitting there with these calls around. My average price is probably about 86 cents. And Tuesday comes around, and it was, we gapped open $2 or $3, and the stock's around 472, 473. So I'm not sticking around very much longer, and I'm selling these things at $1.75, $1.80. So I pick up a doubler, which felt pretty good. But then, things started to come down, slide a little bit. The decay started to kick in, and but then things started to turn around. It's moving up towards 474, 475, and I decided to get back in there and buy some more of those calls Tuesday. So I closed out. I stayed with the trade, and Wednesday is the day where I think Carl Icahn came out and said that he was taking a stake in a company, and it just went bananas. All right, and so those options went up from about I think at the time he announced it, they were at $8 or $9. They went up to like $19 or something like that. It's ridiculous. So from $2 or something like that to $19. Are you kidding me? That's a 900% return, literally overnight. Okay. And yes, I stayed with it. I didn't have all the options that I started with, but I did book some earlier. But look at that leverage, a 900% return. Now you tell me, if you bought the stock of Apple, $500 today, how many lifetimes would you have to live before you owning that stock and getting a 900% return on that particular trade? It might be the year 2500 by the time Apple gets a 900% return on the stock from today. Okay, so look, some of you said, yeah, Icahn will help you. You know what? Yeah, did I get lucky? Sure. That you need to get a little bit lucky when you trade options, right? In terms of timing. All right. None of us have a crystal ball that tells us exactly what's going to happen in the future, do we? I always tell everybody my daughter is the one who broke my crystal ball many years ago. But the point is that yes, you need a little bit of luck. You need a little bit of luck on your side, but you also have to take a little bit of risk too, don't you? You have to allow yourself to take a little bit of risk, and you see the second point here: limit your losses, defined risk. I can define my risk. If I buy 5 contracts at $2, I know I can't lose more than $1,000. Okay, but I've got that potential upside, and if things work in my way, if the chart read is correct, if the environment is right, and things happen exactly as I like to see them. Look, this is not the only time Apple's really cruised like this during expiration week. Okay, it's happened on last year. I think it happened on about 4 or 5 different occasions where you could have made a killing just during expiration week. So managing trades with a little bit less emotion. Now, obviously, this is hard to do when you have what? When you have too much capital dedicated to your trades. All right? This is something that I constantly preach and tell people all the time. You can have a great system, but you can completely blow your account if you're not responsible and you're not disciplined enough to put the right amount of money into your trade. Do you understand what I'm talking about? You know, you can't be swinging for the fences on every single trade because, again, that unknown is out there, and if you're not careful, what's going to happen to you? You're going to get blasted on something you don't completely expect it, and all of a sudden, right out of the blue, bam! You're going to get hammered. Okay, create a system for your trading. And be flexible. Create new trades for old ones. I do this all the time. You know, I mean, I'm constantly fixing trades, repairing trades. I have a trade that I've been in for about the better part of a year and a half. It's been it had been a complete, total disaster loser. I was short puts on Cena from much higher. It's back in the 80s now, but I mean, you can imagine about a year and a half ago when it was over $90, $85, $90. I'm short puts and slightly out of the money puts, and the stock just goes in the toilet. Okay, this stock was in the 40s about a year or so ago, and I'm short puts from the $70 put line from like $5, and now they're like 25. What a disaster, huh? Total disaster. And I didn't protect my downside by buying an extra put, so shame on me. That was a bad move. But now what I've been able to do is I'm selling upside calls, all right, against my short puts. So what that's allowing me to do is do several different things. A, reduce the volatility. B, reducing the overall delta. And C, creating a positive theta for my trade. So I've been doing that over and over again, and I'm actually still short puts on Cena, but they don't expire until January, of course. So I think I'm short these things at about $17 or $18. Now it's like $3.5, $4. But now I'm also, I've coupled that with being short calls. Does that sort of make sense to you guys? Okay. All right. So chart and technical reader's delight. That is why options are also a great tool to use as well. So option trading discipline. A great trader, as I said earlier, can with a great system can really, if they're not careful, if they're not being responsible, can wipe out their account in a matter of a few trades. I've seen it happen. It's happened. It's nearly happened to me. Okay. I've made a lot of money trading options. I've lost a lot of money trading options, and probably more than any of you will see in your lifetime. Okay, and the point is that the one takeaway, the one lesson I have from every bad trade, from every good trade, every bad trade, is to keep the risk down. Keep yourself disciplined. I have a story here for you. It was late last year, and I have a client who I was managing an account for. I won't mention his name, but anyway, I have a client I was managing his account for, and because he came to me and he said, Bob, I'm just getting shelled. I've lost like over $1 million in my account, and I can't. I'm at my wit's end. I don't, So I asked for a little bit of information. He's somewhat of a reckless trader. He's one of those needing the action. He was addicted to the action, right? And needed to keep him. It was almost like he was an intravenous feeding of market action. I've never seen anything like it before. But so I said, okay, let me take the needle out of your arm and take over and help you out. So I traded his account for a little while. Actually, the first week we were up pretty nicely. He gave me a small stake of money, whatever he had left, and we traded it and made some good money. And I said, 1 week we made some decent money, let's stop for a little bit. Well, that wasn't good enough. He decides to take over the account, and he's trading these huge sizes of weekly options. I mean, we're talking like he's buying like 200. He put more money in the account, and he'd blow it by the end of the week. The next week he'd put more money in. Bottom line, the guy lost nearly $500,000 in about 6 weeks. I was literally in shock. It's like I was watching a train wreck happen right before my very eyes. It was an amazing, amazing experience just to watch this. I felt really bad. I don't want people to lose money. None of you like to see people lose money, but I'm telling you something right now. I mean, he's buying these weekly options that, 150, 200, 300 contracts at pennies, looking for that less than 5% chance of winning. You could do it over and over and over and over and over again, and eventually you're going to get it right. But how much money are you going to lose by the time you get it right? Does that make sense? Okay, so I thought I would share that little story with you. The guy's still alive and kicking here with an account. I have no idea what he's doing. I don't watch it anymore. It was frankly, it was disturbing. It was like watching a horror movie. Okay, and like I said, I felt like I was watching a train wreck happen right before my very eyes. The guy was just a disaster every week. He'd have one good week, and then one good trade or two good trades, and he'd give it all back and then some on the next couple of trades. It was unbelievable. So we've all been there, right? Hopefully not. Hopefully not too many times. All right, so let's move on here. So size matters. In this case, keeping your size under control. Okay. As much as we might love to be in a trade, you can't be reckless. You can't size it too much. I did this recently. Okay, I put lots of Oracle in several of my accounts because the earnings came out. This was in June, not this is the June quarter. They're not going to blow it, right? It's a low beta name. There's no way I can really. I mean, they're not going to blow. They're not going to get pasted, right? Like in March. Sure enough, they got drilled, and I oversized it a little bit, not too much. I learned my lesson a long time ago not to really go hog wild, but I did have a little bit more at risk on this particular trade. I had some call spreads, and it's stung because the stock got hammered. I didn't expect it to happen that way, and I put my tail through my legs, and I ended up having to make that up on some other trades. It was just a really emotional roller coaster there for a couple of days. Usually, I mean, I get hit with some adverse trading results like we all do, and you know what? I brush it off and move on to the next trade. But you know what? You get stung by a trade where you make a stupid mistake by oversizing it, and what happens? You end up having to make that up on the next couple of trades, and hopefully those go in your direction. Losses, they're part of the game. You just got to deal with it. It's part of trading. Trading is not a game of perfect. And if you're seeking perfection, trust me, you're going to end up a loser at the end of the day. Option trading, a lot of people think that option trading is like gambling. It doesn't have to be like that. We'll talk about that a little bit later on with premium selling, which is one of my favorite things I like to do. I talked about it a little bit today in my webinar earlier this afternoon. And this is where we're talking about this right now. It's 80% of options, outstanding options, expire worthless every month. Okay, 80%. So think about that, folks. Think about that for a minute. If you're a premium seller, and what I mean by premium seller, all you're doing is taking the other side of a trade. If you're not buying calls, if you're not buying puts, you're selling calls and you're selling puts. If you want the other side of the action, okay. So if you're a seller of premium, you basically have a 4 out of 5 chance of winning, right? Every week, every month. Make sense? You agree? 4 out of 5, 80% chance of winning. That's better odds than the house has in Vegas. So selling the premium, putting the time decay in your favor, right, puts the burden of higher prices on the buyer. Okay, and so we're currently in an environment that is really favorable to the option seller. And why is that? Because in an environment where options or volatility is low or even declining, and of course we have these little spikes in volatility like we had earlier this week, last week, in June, in April. We have these spikes. These spikes up in volatility are great opportunities to get short vol or sell some premium. When volatility is spiking, what's happening to option price? Or option pricing getting more expensive or getting cheaper? Let me put that out there. Anybody? More expensive, Brad, you got it right. Scott got it right, positive. More expensive, Robbie, John, excellent. Which, by the way, let me step back just a minute. When I do these webinars, I like to be somewhat interactive. I like to ask questions. I like to see if you guys are paying attention in the audience, because this is the way you learn. Okay, you can listen to me and hear what I have to say, and hopefully you gain some knowledge out of it. But what's more important to me is have you guys think and have you guys react and have you guys answer some questions here. So that's how I like to teach. So getting back to the option, high percentage option trading, selling the premium and put decay puts time decay in your favor, right? What I'll often do is I'll often sell put spreads on stocks that I wouldn't mind owning, say, at a lower price. So let's take a look, for instance, at something like IBM, right? IBM's trading at about 185 right now, right? Roughly. Let's say you wouldn't mind having, I wouldn't mind having IBM at 180, but I don't want to wait for it. I want to be proactive on this thing. So what I would tend to do is I would sell the 180 put, right? And so selling the 180 put is going to put some premium in my pocket, right? But what if market conditions are such that we're what, 4% from a high of an all-time high, roughly. Tech has been dreadful outside of a couple of names, and what if we start correcting and IBM just blows right through that 180 level? I'm going to get the stock put to me, and what if it goes down to 160, right? We don't know. So what I'll do is I will sell the 180 put, and I will protect myself by buying another put. So some of you are familiar with premium selling, put spreads, that sort of stuff. I'm not sure if you are or not, but I'm just going to start from a basic premise here. I'm selling the 180 put, and then I'm maybe buying the 170 put, and I've got a 10-point spread over there, right? I feel that's pretty safe at this point with the stock at 185, and if it does break 180, then I'm going to have the stock put to me, but I'm going to take in some premium in the meantime, right? Depending on how far I want to go out there. Maybe I want to go out to October, November, or something like that. So I'm going to take in the premium, the difference between the time premium that's offered currently right now, like maybe $2.5 between 180 and 170, right? So if I do get the stock put to me at that price, then what's going to end up happening? I'm going to end up getting I'm going to get that stock put to me, but you deduct out the premium that I collected and actually reduces the cost of the stock. So let's say I picked up $2.5 and I get the stock put to me at 180. My average cost is actually 177.50, right? Because you take that off the 180 price that you're going to get the stock put to you. So you've basically accomplished a couple of goals here. What you've done is you've taken in some premium, you've allowed yourself to wait for the stock to come back to you, and you've locked yourself in at that price that you would like to buy it at. Let's say it doesn't go there to 180. Let's just stays above there, 185, 190, maybe even goes higher. Those puts that you sold are going to do what? They're going to decline, right? And they're going to decay, and you're going to end up keeping that premium for selling those puts. And you can just do it over and over and over again. Premium selling is a great activity. If you're into income, increasing your income, it's also a great way to do it. I have a guy who made a killing for about nearly a year. I think it was 11 months straight, selling call and put premium on Target, the retailer. Okay, Target every single month. If you look back a few years, I can't remember when it was. It might be, gosh, it might be 2006 or 2007. I have to take a look at the chart, but there was a time there that this stock was locked into a range. I mean, it was about a 3 to 4 point range for month after month after month. So if all you had to do was sell a strike out of the money from the high range and one strike below out of the low range, and you collected a beautiful dividend every month. I mean, I think you collected like 60 to 70 cents a month by selling premium up on the call and the put. And he wasn't worried about getting getting it called away because he was selling it outside the bands, which means he's selling it outside the 95% range, right? So it was a 5% chance or less that he was going to get taken out. So anyway, month after month after month. So obviously, if you own the stock and you're collecting a dividend, and then you're doing this call and put selling strategy, you're making a killing, right? Because even though the stock's not going anywhere, you're not making any money appreciating with the stock price, you're still raking in income month after month. Does that make sense? Yeah, I haven't been. You're correct. I haven't been able to share the charts because I'm having a little bit difficulty sharing my screen. So sorry about that. So let's see here. So let's move on a little bit more here. Let's say you're. How do you deal with a winner? I want to start positively, and we'll talk about dealing with a loser next. But how do we deal with a winner? It's really not. You can have a winner on the books or a winner that you haven't booked yet. But is it really a winner if you haven't sold it? No, it's not. It really isn't. It's on paper. It's a winner. It looks great. Your P&L is looking good. Your account's higher than it was prior. But it's really not a winner until you sell. And I just go back to what we talked about earlier about selling. Selling is the most liberating experience you will ever have. And I love to sell. I love to sell. Today was a great day to sell. Okay, we were selling positions today. In my accounts, I was selling positions today as the market was rising. Okay, I'm mostly, like I said, when I'm selling premium, I'm closing these out, which means I'm buying the puts back or the put spreads back, or if I'm long calls, I'm selling calls during the day. So I constantly get questions about this, and they're saying, well, Bob, I don't understand. The market's taking off today. Why wouldn't you be buying today? You got to think differently, folks. You got to think the other way. You got to think about this is the time to be selling when the market is rising. If you already have positions, okay. If you're looking for new positions, it's a different story. If you've been waiting on the sidelines, you got to figure out time to get back in the game. That's a completely different story. But if you already have positions on, great day to be selling. Just like when you're sitting with puts, long puts, or selling or short calls, when is a great time to be closing those positions? When the market's getting pasted, right? When the market's getting hammered, you want to be closing those positions. You want to be establishing those things, right? Okay. Let's see here. Your options expand when you have a winner. And what do we mean by that? When you have a winner on your hands, all right, your universe completely opens up. And what does that mean? That means the options, the flexibility that you have opens up. Maybe you have a long call and that you've got a doubler on it. You can take half of that off the table and then give yourself a chance to stay with a free trade. You can also sell some upside calls to protect your gains. You can buy a put. You can roll it. What I call it, one of my better strategies I like to use is called lock and roll. Lock your gains, roll it to the next month. Okay, you have lots of different options, flexibility to go with your trades when you have a winner. Even when you have a loser, we'll talk about that in just a minute. You can create different structures. You can, if you say your long calls, you can create a vertical spread. You can go long a call and then you want to protect yourself. You want to stay with that call, but you want to protect your downside just in case something happens. Buy a put, create a strangle. You can lock in gains. You can open up new trades. You can also protect that position by doing any multiples of ratio spreads. Okay, lots of different things you can do. So let's go to the flip side. How do you handle a loser? Handling a loser. That's, again, this is one of those things, most difficult things that people have trouble handling. And what I mean by that is, nobody wants to be wrong. Okay, raise your hand if you're proud of being wrong. I'm sure not many of you are raising your hand right now, are you? And the reason for that is because we have an ego, right? We all have pride, and we all have an ego, and we all want to see our accounts go up. When we're talking about money, and we're talking about our wealth, we're talking about increasing our value of our net worth. It has nothing to do with our self-worth, but our net worth, right? We all want to. There's only one way to increase that value is to win on a trade, right? So when we're facing a loser, that means our net worth is going down. So and our ego is getting dumped to the floor. And in fact, for most people, it's the ego that is the thing that gets in the way of success, right? And what I mean by that is you get into a trade and it goes down on you. All of a sudden, what's happening? You become defensive, right? Have you been in that situation where the timing is just not right, and you end up losing money on a particular trade? And what happens? You go into denial, right? You start saying, you know what, this can't be happening to me. I have a loser? No. I'm a perfect trader, right? This is not happening to me. So we end up putting ourselves into a mental funk over here, and we end up staying with a loser over and over and over again, longer and longer. And again, remember that example I gave you about looking at your P&L every single day, and you end up looking at that loser every single day. So it's like a scarlet letter, right? It's like you're branded, right? So what I do is I cut it. I cut it down. I remove it. It's like cutting cancer out of your body, right? But there's a methodology that I have to go through first. What's the chart telling me? Is the chart telling me the patterns have changed? And again, remember how I told you from the beginning, I always start with the chart. Okay? I always start with the chart. And from there, then I go to the option trade. So if the chart is telling me it's time to get out, then I got to get out. Did I buy the right option, or did I buy the wrong option? Did I pick the wrong strike, the wrong month? That's an easily correctable situation. You can use the time that you have as well too. Oftentimes I will buy an option that's out of money. Maybe I'll buy let's see, Apple's trading at $500. Our Priceline's trading at $960. I may buy $1,000 the $990 option, right? Because I think it's going to go to $1,000. So what am I buying if I'm buying the $990 call? What is that? If the stock is $960 and I'm buying the $990 call, what am I buying? I'm buying time, right? I'm buying an option that is all full of time, right? Out of the money call. That's right, Monty. I'm buying an out of the money call. I'm just buying time. So let's say we're in August right now. Let's say I'm buying an October call, right? So simply put, if I'm buying time, don't I have the right to use all that time? Of course I do. I can use all the time that I want, all the way up until the expiration of that option. And you know what? You're entitled to do that. But what is the fear? Well, the fear that we have is we're going to lose money. And if we're losing money quickly, then it's in our minds that we have a loser, that we have to correct that situation. So for most people, handling a loser is just dumping it and not taking a methodological approach, to analyzing what that trade is really all about. Okay. Maybe it's an earnings play. You can just sink or swim. Oftentimes I'm in these earning trades. I prefer to do something that's called a strangle, which is buying a call and buying a put simultaneously if I'm looking for a volatility move. But sometimes I'm just going directional. You want to know? I don't mind telling you about my losers. I do it all the time on Twitter. I do it all the time in my service. I tell people all about it because it's part of the game. What did I buy yesterday? I bought the biggest loser on the board yesterday. Anybody know what that was? I was long calls Hewlett-Packard going into the earnings yesterday. All right, I can see all of you saying, ouch, 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 all right? Yeah, so what? You know what? I mean, it was unfortunately, it was a bad situation. It was a bad deal. We lost money on it. and it is what it is. We just moved on, and all of a sudden, it's out of the portfolio. Not even thinking about it any longer. These things happen. Okay, I take my shot. I take my bet. It's small. It's not huge. It's not going to kill me if it loses. I got a little stinger today. I pulled the stinger out of my arm, and I'm done with it. Moving on to the next trade. Okay. Let's see. No regret selling a loser. You just move on. All right. Is there another play here? Perhaps a reversal? These are things you have to think about. Again, all these things going through your mind. You never have to feel like you're being stuck in the mud when you have a trade on. All right. Fresh eyes can also help you find a new trade. In other words, let's say you get out, you're in a losing trade, but you know it's just a timing thing for you. Maybe you had the chart read correct, and maybe it's just the wrong strike. You kill that trade, take a day off, come back to the chart like the next day, and with a fresh set of eyes, maybe you're analyzing a little bit better. You're able to have a clear head. There's no emotions involved. You don't have any attachment with any position, and you analyze a little bit differently, and maybe you come to a better conclusion, and you find a better trade out there. So one of my favorite things I talk about is dealing with noise and distractions. I mean, what are we talking about with noise and distractions? The noise is the media, the hype, all the things that you hear constantly on places like CNBC and Bloomberg and Fox or whatever. Okay, in the news, in publications like the Wall Street Journal and Barron's and Business Week and all these other things. This is all, folks. This is all noise. These are all things that are distractions for you to get you off your game. The only real thing that you should be paying attention to is what? M, the market. Okay. Does anybody raise your hand if you follow the IBD, Investor Business Daily? Anybody? Okay, IBD, yeah. Okay. Everybody familiar with their acronym CAN-SLIM? CAN-SLIM, everybody know that one? Okay. What does the M stand for? It's the most important thing. What does the M stand for? Sorry, Tony, that's not right. M stands for market. Market. Thank you, Mike. Mike got it right. Boy, I'm sorry. A lot of you guys are investor business IBD followers. You don't even know what CAN-SLIM means. Can't believe it. Okay. Market. M. The market is the most important thing. If the market is not cooperating with you, then you're left out in the cold, right? If the market is not cooperating, then you're fighting an uphill battle here. So pay attention to what the market is doing. Don't listen to what some yahoos are saying on CNBC, some analysts, some pundits, whatever. Because let me tell you something right now, okay? Back in 2007 and 2008, when 2007 when the market was making all-time highs, and 2008 when the market was tanking from the Lehman Brothers all the way to the end of the year and into early 2009, every single analyst just about came on the boob tube saying, buy this market. This is the buy of a lifetime. And we continue to go lower and lower and lower and lower and lower. Okay? Sure, some people said buy in March of 2009. It was the buy of a lifetime. There's hardly anybody that I know that bought stocks down there and are still with them today, 4.5 years later. Okay? There just aren't many out there. Okay? You can say what you want. I know the truth. Okay? There's not many people that have stayed with stuff since that point in time. If they got in there, they got lucky because the Armageddon scenario didn't play out, fortunately. But the thing is that we recognized that we were in a situation that was very, very difficult, very, very challenging. Yet every talking head was coming on and saying buy, buy, buy all the way down. Okay. Not the way you go about approaching things. You've got to pay attention to what the market is telling you. The message of the market is the most important thing. You need to learn how to navigate the markets regularly during the day and during the week. And recognize that everyone has an opinion, all right? But those opinions are loud and they're noisy, and they are biased. But if you instead look at the facts and pay attention to the facts and use those to help your decision-making process, you're going to find out that your head is much clearer and clearer, and you're much more focused and able to concentrate on your trading regularly during the day. And don't let it influence how you act. Got a few more slides left on this one, and I think Jeanette's going to load up the next amount of slides here after we're done here. So we talked earlier about making the correct choice when it comes to buying options, right? Do we need more time? Do we need more room? And really simply put, that's about execution and about finding the right trade idea. And oftentimes, if I'll look at a good volume on a particular option, and I'll take a 1 or 2 strikes further in the money to give myself a little bit more ability to stay with the trade a little bit longer, so I won't get faked out by any quick adverse move. I'll give you an example. Like we're in this trade of Cliffs Natural. CLF had a really strong day today, and last 3, 4, 5 days, the stock has been really weak. After having a big run up to 25, it had come down near 20, 21 or 21 and a quarter. Had a really strong day today, but if you'd have bought an at-the-money call in the last 7 to 9 days, you probably would have stopped yourself out or got yourself out of the trade because the market was weak, the resource names were also very weak, and you got out of the trade. Well, you wouldn't have been probably wouldn't have been participating in today's really strong move. I think it was up about almost 6% today. So what kind of momentum does the stock have? And we talked about Apple earlier, Priceline. Google is one of those momentum names, high price names. Amazon, Netflix is one I like to play quite often. I'm gonna give you one of my secrets here that tends to work for me quite frequently with some good percentages. The deltas. Everyone's familiar with the Greeks here. The delta simply, there's a Greek, there's the gamma, the theta, rho, delta, and all these are different characteristics of options trading. Now, talking about the delta, now what the delta is, there's a percentage that is assigned based on time remaining in the life of the option and where the stock is, right? And simply put, a delta tells you that with every dollar move in the stock, the option will move that in terms of cents. So a delta is anywhere from 0 to 99. So let's say, for instance, a stock is selling at $22. You have an option that's say the 22 strike. The delta is 50 cents or 50%, and so the stock moves $1. The option is going to move 50 cents. So percentage-wise, it tells you. This is the thing that really interests me when I'm looking at a stock that's got potentially some really strong momentum, acceleration, speed, velocity coming into the stock. So I found some of the better deltas help me get really good sizable returns in the option. So when I'm looking for deltas in the 37 to 42 range, with about 2 weeks to go in the life of the option, this is a primo area for me, because once that delta, if the stock really starts making a move, and the delta gets to 50, that option's really going to move. And we're talking maybe, possibly 50% or more. Okay, so this is the sort of strategies that I'm looking for when I'm looking to go long options. Either it puts or calls, doesn't matter. You can also put different structures together. We've done different things like building butterflies, doing iron condors, strangles and straddles, vertical spreads. Calendars are also great to use. Diagonals, double diagonal calendars are also good to use. Butterfly spreads are great to use during earnings. But you also have to pay attention to what? You got to pay attention to the volatility, the implied volatility, which is what the market is expecting that stock to do, that option to do, right? Okay. Now Bud asked a question here. I'm going to try and pick off a couple of these questions. So Bud asked, "What are your best deltas for selling options?" And again, I like to sell out of the money puts and out of the money calls. So some of the better deltas to sell are 25 or lower, 25% or lower. So I'm generally selling the higher percentage. So that gives me about a 75% win or higher. Sometimes I'll even go even lower than that. But I like to take a lot of premium in. So, but there's sometimes what I like to do is do what's called a one-for-one. What a one-for-one is, let's say you have a stock that is selling at 180 bucks, right? $180 stock, and I'm gonna sell like the 185 put, and I'm gonna buy the 175 put. So basically, for it's a $10 spread. Let's say I'm selling it for $5, right? So I'm risking one to make one, right? So what that means is the worst I could do is pay another $5 if the stock tanks below the long put strike, right? The best I can do is that if it goes soaring past the short put strike, that decay kicks in and the option maybe collapses to zero or close to it, right? So, but I'm risking one to make one. So I like to take in a lot of premium. I told you earlier, I'm a big game hunter. I'm not going for the 25, 30 cents super high probability trade. That just doesn't move the needle for me. I want to collect a lot of premium. I want to collect a large amount in my trades. That's just my style. This is the way I do things. I mean, for other people, they like the safer, better than 95% win rate. So maybe out 2 standard deviations or more out. So Frenchie asked a question here. What's more important, option interest or option volatility? Option interest, you mean the open interest, or option volatility? One's not more important than the other. I think they're both really important elements as it comes to options trading. You've got to understand that if you're not you don't want to be trading in an option that doesn't have much open interest, because it becomes a to-whomer, and what that means is you're going to sell it to whom? Who are you going to sell it to? If you're going to buy it, you're going to buy the open interest. Who's going to buy it? Who's going to sell? Who's going to buy it from you? Right? Unless you go deep in the money and you can exercise it, what good is it going to do you? Option volatility is extremely important to understand, because you want to know, are you paying up for an option, or are you not? So one good example of this is a trade that we did in June, towards the end of the right before earnings season started, on BlackBerry and Research Motion. BlackBerry is the symbol BBRY, and the stock was trading around 15 or so, and we bought some. And I was looking at. I was thinking about just going long, buying some vertical call spreads, because they had a good earnings report in March, and I thought, they're probably going to come out and do another good earnings report as well in June. But that was my thinking. That was my emotions. That was my heart saying that they're probably going to do it. But those things are irrational and irrelevant when it comes to making money, right? We can't have our heart into a trade. We have to think with our minds. So in this particular case, I said, all right, I think it's going to have some upside, but what if I'm wrong? I could be wrong. So let's take a look at a put as well. So we bought the 16 call, and we bought the 14 put for about $1.60 or something like that. And of course, what happened? It's really, when you're buying a strangle, you're buying volatility. You're buying for a big move. There's 3 different types of option trades. There's time, there's volatility, and there is direction, right? So in this particular case, I'm buying volatility for a big volatility move, right? And in this case, after earnings came out, BlackBerry just got drilled, and we ended up making a nice chunk of a coin on that one. So that's really what we're looking for. We're looking for a big volatility move, when it's not necessarily priced in. In this particular case, you would have expected BlackBerry in front of earnings to have a pretty substantial implied volatility, right? But it was actually low. So the market wasn't expecting a big move. It got it. It dropped 40%, so it got the big move unexpectedly for the market. Okay, does that make sense, Frenchie? A couple other questions here. Jeanette, I hope you don't mind me kind of going off the reservation here and taking a few of these questions as we're going through here. I guess I got a lot of time left. Everybody enjoying this so far? Am I doing okay? Hope you're enjoying the webinar. Okay, great. Okay, let's see here. Let's see. So you mentioned you like a delta of 25, but above the delta, okay, a delta of 25 is when I'm selling, WK. When I'm selling premium, I like a delta of 25 or lower. When I'm buying a premium, in this particular case with a couple of weeks to go, when I'm buying an option, buying a call or buying a put, I'm looking for a delta between 37 and 42 because once that hits 50, that's when it really is going to move. The option, that is. Make sense? Okay, hold on a minute. All right. Let's see here. All right, moving on. Moving on here. Let's see here. Any more questions here? Okay, so what is more important than sell volatility but don't be all the open interest? More important, sell volatility. Yeah, that's right, Mike. Sell volatility when volatility is spiking, when volatility is high. That's correct. How do you determine if you want to be directional or want to go non-directional on an earnings call? That's a good question, Stan. Basically, it's a particular choice at the time. And we could go directional on a trade, or we could possibly well, I don't know if that Steven says 50-50 shot. That could be right. It just depends on what the setup is at the time, and there's lots of different elements involved. But again, if you go with the strangle, and you're looking for a volatility move, well, I get this all the time. Hey, Bob, you're buying a call and a put. How can you make money? I'm making money because obviously one side's going to cancel out, and the other side is going to be a huge winner, right? All right. So this slide says how to sell on time, and let's remember something. What did we say? What did I say earlier about selling? When we're in a situation, let's say right out of the gate. By the way, I confess that every single time I get into an options trade, I start out being a loser. Okay? That happens. I accept it, and I don't mean a loser in the personal sense. What I mean is that I'm a loser in the trade probably right away. And what happened? Why is that? Because if I'm a buyer, okay, of an option, that decay is going to start working against me right away, isn't it? It's like what happens when you buy a brand new car and you drive it off the lot? It automatically goes down in value, doesn't it? It goes down in value. You're never going to see that value come back. It's no different than options trading when you're a buyer. So, but I recognize that I have time to let that option work. Somebody said to me yesterday in our trading room, said that, Bob, you're buying weekly options that expire on Friday. Boy, we really need it. We have, what? You have 2 days. If you're buying it on Wednesday, I've got 13 hours for that to move, right? 6.5 hours today and 6.5 hours tomorrow, right? So, but if we're paying attention to the chart, and we see, in this case, during expiration week with only 2 or 3 days to go, I'm looking at 15-minute charts. I'm looking at 60-minute charts, not looking at the daily like I normally am. And if we're recognizing that a big move is at hand, like we did, we bought some Baidu yesterday, and we had that big move, strong move up today, up through 140 today. We recognize that that's potentially going to happen. You go with it and use the option leverage in your favor, and if you win, you win. If you don't, you don't. You took your shot, right? It's not a coin flip, though. I don't want you thinking that it's just a gamble, it's just a coin flip, 50-50 or something like that. Everything for me is based on the premise of the chart. I'm looking at the chart at all times, right? And taking a look. And if the structure is still there, if the pattern hasn't broken down, if it's still safe to stay in the game, stay on that play, then I will. I can stay with it all the way up until the end. In fact, I've stayed with trades all the way up until about 3 to 5 minutes before the option expires, before the end of the trading day, and then it really moves. We did some last fall, back in November, when the market was really getting drilled, right before Thanksgiving. I'm playing these FAZ, F-A-Z. You know what the FAZ is, right? The triple financial bearish ETF. FAS is the bullish one. The FAZ is the triple bearish. Well, when the financials were getting absolutely just bloodied and pasted, this was a great vehicle to trade. But the thing wasn't moving during the day. It was moving right at the end of the day. The last, literally last 5-10 minutes, you could have made 200 to 300% returns just by holding it the last 10-15 minutes. It was better than a thrill ride. Okay, it was like, you feel like riding a roller coaster. You go up that steep slope, and then really slow. Then all of a sudden you start coming down, and all of a sudden all the excitement happens in the next 2 minutes, right? So all right, so let's move on. Let's move on here. And remember, nobody rings a bell when it's time to sell, and selling is the penultimate liberating experience activity you'll ever do. So this last slide over here, I think, is my last slide. Yeah. Trading breakouts. Momentum trading is best in a trending market. Breakouts often will give you the best chance to win and to take continuation moves because they're high probability, right? We could easily buy protection if we're long on a trade. We can sell options. We have a lot of options, okay? I've written my latest ebook. Again, it's free to the Possible thing. You can email me if you want a copy of it at bob@explosiveoptions.net. Is called "You Have Options with Options," and it's my biggest book that I've written. It's about 25-30 pages. It's almost done, almost ready to go for release, and it really spans the universe of trading options and all the different things that you can do. To give yourself the flexibility to stay with a trade, to make a winning trade, to repair bad trades. You can easily buy protection. You can also work to the upside or the downside. So that's the last slide over here. Say, Jeanette, do you want to go ahead and put in the other slides that I gave you? And maybe I'll ask some questions. I'll answer some questions while you're doing that. What drives implied volatility? Well, many things, stocks, earnings, Yep. Also, volatility of major index. If you knew the high and low for the next day within a few ticks, how could you play this with options? How would you? I don't understand. If you knew the high and low for the next day, I don't have a, Glenn, I don't have a crystal ball. I don't know exactly what the high and low are going to be. So that's seems like a trick question there. Sell high volatility, buy low volatility, and proper setups. That's correct. The email address, Naga, is bob@explosiveoptions.net. Okay, we've got a little bit of time left here. Jeanette, how we doing? Everything okay? I don't want to.
Hey, yeah, everything's great.
I guess
you
what should I say? I think we can roll with this one if that's okay.
Sharing, or do you want to just roll with this?
I guess would I just hit that green desktop sharing? Do I hit that green desktop sharing button up there? Or was that going to show my desktop?
Yeah, I mean, it don't matter to me. Just go ahead. You're good. You can go ahead.
Oh, you know what? That's what happened last time. It booted me out of there
Hit
last
that,
time.
and then
So,
it'll
you know,
say
I mean,
start desktop sharing, and then
maybe it's just to be on the safe side. I should just not
select
do
which
that.
window that you
I
need.
apologize, everyone, for not being able to share any charts with you tonight and share my screen. Okay, all right. Okay, so hopefully everybody's enjoying it. All right, so selling premium. I'm going to talk about that for a little bit.
Just go with your slides. It's fine.
Let's see here. Okay, so selling premium for income. I like to allude to this as creating your own dividend and selling premium each month, right? And creating your own dividend allows you to sell premium. It's a consistently good strategy. You can roll forward at any time, and you can wait until the options expire worthless, but you have risk. And I'm gonna talk about the I talked about the Goldman Sachs story earlier in my webinar earlier today. A story of waiting until the end that was a really bad decision. Some of you remember it was a couple of Aprils ago. I think it was probably, I want to say 2010. I'm short some Goldman Sachs puts, and I picked up some good premium on these things, and we're at expiration Friday, and it's about 9 o'clock in the morning my time, and these things are worth about 3 cents. So it really wouldn't have cost me anything to buy these things back. I'm short probably 10 puts, right? Picked up $1.70 or $1.80. I'm not short a put spread. I'm short the regular puts, right? And it was, I want to say it was in the middle of April. And then all of a sudden, what happened? The SEC comes out with an investigation about Goldman Sachs. This is Friday expiration. They could have done this on Saturday, right? They had to do it on Friday. Expiration Friday. So what happens? Goldman Sachs, which the price was far out of the money of my strike, it starts to tank. It immediately dropped, bam, $9, right out of the gate. So my option goes from, and I was $7, $8 out of the money. So I had a lot of cushion, right? Immediately my option goes from like 3 cents to like $1.20. I'm still got a winner, but I ended up, not doing anything. So I said, oh, you know what? This is just an anomaly. This is going to go away. The stock's going to go back up, right? I've got 4.5 hours to wait, and then I'm clean, right? Why do I have to buy this thing back, right? You think about it. Logically, it doesn't make sense to buy this thing back. Sure enough, the stock tanks another $5, and it tanked a little bit more and bounced back, and then it tanked. Bottom line is, I'm buying these options back at $4. All right, they were 3 cents. I could have bought the thing back at 3 cents for pennies, right? 10 options, $30. I ended up buying them back for $4 grand. $30 to $4 grand. I mean, obviously, if I was a buyer of those options, nice lottery ticket, right? But you can see the problem to get into by not protecting yourself and not being prudent and not being smart, right? All right. When is it a great time to sell premium? As I said earlier, when volatility is low, volatility is declining. When you want to enter a stock at a lower price at a future date, I'll give you that example about IBM. And remember something: time is your friend when you're selling premium. Currently, we're in a market that is not correlated. I'll talk about that in just a minute. It's a great time to sell premium on equity. And trending markets are ideal. So let's talk about correlation here for a minute. What do I mean when the market is not correlated with stocks right now? Does everybody understand what this concept is all about? What is a market that is not correlated? Anybody? Tony, you're very, very close. Laura, no, it's not quite inefficient, and it's not bonds and equity. What I'm saying here is this. Does everybody know the difference between a stock market and a market of stocks? Okay. A non-correlated market means that stocks can move on their own without the influence of the market. Now, have we had times where the market is pretty much dictating where we're going with stocks? Yes, we do. You bet. 2011, right? Right after the tsunami hit in Japan, we had a big rise in volatility, and we had markets moving basically everything, right? Especially in August and September through November of 2011, when we had that whole, remember we got the debt downgrade from S&P, right? That caused a lot of angst, a lot of anxiety in the markets, right? So it didn't matter how good the news was on a stock. If the market was going down, your stock. Your stock, the market was, goes down to Chinatown. Everything, it was taking everything with it. All right. But today we're in a situation where volatility is not really that much of an issue in this market. It's not creating a lot of wreaking a lot of havoc here. So basically, we've got a non-correlated market. We've got a market of stocks, which means it's an ideal environment for what? For a stock picker, right? It's an ideal environment for a stock picker. So a stock picker can come in there and do some analysis. For me, it's doing chart analysis, technical analysis. Do an analysis, and you can go out and make a trade and believe that whatever the influences of the market, it's not necessarily going to hit your trade. I love that. All right, let's look at what happened recently. Anybody remember last month when Google's earnings came out? What happened to Google? Google got pasted, right? Okay, Google got hammered. So basically, the market was up the next day, but Google's getting hammered. How about Apple the following week? Apple's earnings came out; they were really strong, and Apple was up 5%. I think it was up to almost $20 or something like that. The market was flat. Fast forward a few days later, Facebook, right? Facebook earnings came out, and they were spectacular. And the stock gapped up like 24, 25%, which is something ridiculous, right? The market was getting hammered. So what this tells you is that the surroundings, the environment are such that it's going to reward a stock picker more often than not. Well, that's the current environment we're in right now. It's good for me. I like it. I'm a stock picker. I pick stocks and I find option trades behind those stocks. All right. In another environment like we had in 2011, I wasn't participating much at all because I didn't feel like I had an edge. I didn't have it. So somebody asked me a question here. TPub says, "Don't you get more premium under high volatility?" Yes, you do. That's correct. But in a high volatility environment, you've got you can pay up for that volatility and you can sell premium, right? But if we're just chopping up and down and volatility is going up, do you want to be short vol when volatility is rising? I don't think so. Okay, when you've got when the trend, what I'm saying is that we'll have short little mini trends of strength and volatility right now, but we're in an environment that is historically low volatility. The VIX is what 13.5% today, right? It fell sharply from yesterday. We had a big move up yesterday as the September became the front month for VIX, and then we rose up and we went down and we went back up in the VIX yesterday. And today we came crashing down in volatility because of what? The uncertainty from the Fed minutes was removed. We're going to see a lot more unwinding of volatility into next week. And why is that? Because I suspect that some of the news that people are expecting to hear from Jackson Hole meeting over the weekend at the Kansas City Fed is going to be removed. And then what we're going to have is a market heading into a holiday weekend. And what do we know about holiday weekend? Going to a holiday weekend, we see volatility get sucked out before the holiday. All right. So when the market is not correlated, which is right now, it's a great time to be selling premium. I'm not necessarily looking for the most premium. unless I'm putting myself in a situation where, I told you that one-to-one risk, okay? I just understand something, that when you're in a low volatility environment, you're not going to get paid a large amount of premium for going for those high percentage, high probability trades, right? You're going to sell deep out of the money, far out of the money puts, or far out of the money calls. You're going to collect maybe 25, 30, 40 cents. That's good for some people. It's not my style. Does that make sense? If you expect a large drop in volatility, you can sell a strangle. That's correct, WK. That's absolutely correct. That's a great way to do it. That's a great way to sell a strangle, because when you're looking for a contraction in the zone, in the range of that price after a particular event, you can sell a strangle, you can sell a call, and sell a put, and you can take that premium in. That's exactly right. So here's an example of the VIX. Actually, it's a much more recent VIX over here, and you can see here on the chart that volatility spiked in earlier in the month, in April, May, June, July. This is July and into early August. And this is towards the end of August over here, end of July, excuse me. And we spiked up there and came right back down, and in a big way. So these big spikes have been great areas to sell volatility, right? Because they're not lasting for very long. We go to these extremes, and I use other sentiment measures, not just the VIX. I use the put-call ratio. I'll also use the McClellan oscillator. Oh, by the way, the other day on was it Monday or Tuesday? I want to say Tuesday. McClellan oscillator closed at a minus 300. I don't know if any of you use the McClellan oscillator, MCO, the NIMOT, or the MADOT. So basically, what we had was a condition on the NIMOT, which is the New York Stock Exchange McClellan oscillator, of a minus 300 condition. Previous 3 times we had minus 300 earlier this year. We had a big, giant, powerful rally. Okay, so that actually was a condition that was met on Tuesday on the close. We were at minus 300. So basically, that particular condition was ripe for a sharp move up in the market. So Bruce says he needs an opinion on a strategy. Go ahead and ask. I'm going to go ahead and answer your question here, Bruce. Bob, we need your opinion on a strategy. As an example, Baidu is 135, then if Baidu is 135, then buy the 125 call, sell the 125, sell the 120 call. So basically, and also sell the 120 put in a delta neutral manner. Do this 1.5 months out and let the time decay work in your favor to close out the positions closer to expiration. Do this on 3 or 4 stocks, 3 or 4 good margin in account. What do you think? Would you do it differently? If so, what? Why? If it's a delta neutral strategy, you're looking for, basically what are you looking for? You're basically financing your short your short call spread with a short put, right? So you're looking for a little bit. You're looking for income, right? Yeah. Okay. So basically this is a nice little strategy to gain a little bit of income. But what happens if the stock gets volatile? What happens if the stock gets really volatile here? You're going to be in trouble, especially if the stock starts moving lower. That short put is gonna. You're not going to collect enough on the short call spread to save yourself on the put, right? You're going to have to end up probably creating a condor or something like that. But you got the margin to save you there. So that might be. It's an interesting type of strategy. Yes, large margin requirement is on this particular type of structure. So, all right. So, as far as the strategy is concerned, is it selling puts or call spreads? Selling put or call spreads? I like selling puts. I like selling calls in a spread fashion because it allows you to participate in a move without any cash outlay. And obviously a margin to post here, but it allows you to participate in the move with little or no cash outlay. You can define your risk by selling put spreads. And I told you if you do a spread like a 5-point spread, the most you can lose is that 5 points plus whatever, or without the premium you've already collected. You can move in and out at any time, and you can use options to roll these up or out if you wish. You always have some flexibility. And here's an example of a short put spread. Kind of hard to read here unless you can expand your screen out. You can see here that the put spread graphic over here shows you your defined risk between the red lines here, and it shows you your profit graph with the white. This is off the Thinkorswim. And here's the other one is the short call spread. Here again, here's your defined range with the red bars up and down, and your profit zone with the white. So that's the last slide I have there for that. I think, Jeanette, again, I'm sorry for not being able to share my desktop with you guys all here, but I'm thinking maybe we have some questions here. We've got about 12, 15 minutes left to go. Should we take some questions? And I apologize if you did ask a question and it rolled by here, and I missed it. Please ask it again. McClellan oscillator. Okay. Kat asked about McClellan here. Let's see here. McClellan oscillator basically is the up and down volume and the up and down issues. And the summation index is actually a better read on overall sentiment and volume. Okay, but the McClellan summation is part of the McClellan tools. But the McClellan oscillator is really good when it reaches a very extreme level to the upside or the downside. Odds are pretty good that a reversal is at hand. Okay. Anything else? And again, I apologize if I missed a question of yours earlier. Jeanette, did you have any questions at all on anything? Let's see here. Can you show the selling put or call spread slide again? Yep. What is typical seasonality going into long weekend? Seasonality means basically that volatility is going to shrink. Okay, I suspect that we'll probably see volatility. They're sucking volatility down into next Friday, as we have the holiday weekend coming up the following weekend. John says, if selling a put spread, Bob, when do you close the short leg if being threatened? You can do it at any time. You can close that out. Let's say you feel like you're wrong in the move, right? This doesn't happen very often, but say I'm wrong in predicting the move, and I want to stay long. All of a sudden, the trend changes, and I want to stay with a long put. You could buy that put back, the short put back, at any time, and then just ride up the long put, right? You can turn that one into a spread if you want to, or just stay long the put. If things have changed, things have switched, and you feel that, okay, I want to stay with this trade because now it's going in the other direction. You can do it any time if your short leg is being threatened. What moves the implied volatility? Well, it's the market expectations, Leon. It's the market expectations of what this stock is going to do. Okay, and the market's going to price in a particular move based on historical volatility. All right, or based on what the hype is, what the price is that people are willing to pay for it, Okay. If you go into McDonald's, or let's say you go grab a Subway sandwich. Why is it $5 in one place and it's $7 in another? All right. Are you willing to pay $5 or $7? You want to pay $5, right? But some people are going to pay the $7 just because it's there. It's convenient, right? So basically, what you have there is you got a situation where it doesn't matter. I'm going to get the same thing, but I'm going to pay up for it. And if somebody's willing to pay for it, well, duh, you're going to go out and offer it at that higher price. So you have nobody willing to pay for it. How do you handle the FOMC announcement time frame when you were trading options? That's from Bruce. Okay. Let's see. Again, this is just some more hype. You have to understand the Federal Reserve, the FOMC announcement is this FOMC, this Federal Reserve has been more transparent than any we've ever had, than any that we've ever seen before. So really, these announcements are really kind of a joke because we already know what they're saying, what they mean, and what's going on, right? You really can't glean any new information. I looked at the minutes yesterday. I summarized them up on Real Money this afternoon, or this morning, and then a little bit more this afternoon. And you really couldn't glean a heck of a lot more differently than what we've been hearing from these Fed governors in their recent speeches and announcements and media interviews. Okay, nothing new. We didn't learn anything from this one, but this next Fed meeting is the big one, the one in September. It's a 2-dayer, all right, and they're going to have some new projections about the economy and about their assessment of where things are going, and we're probably going to get a little bit more information on how and when they're going to cut back on the bond purchases. And I'm not going to use that T word. Okay, sorry, it's not. It's a word that was created to use to talk about cutting back on their bond purchases. You know the T word I'm talking about, right? I won't use that term because it was made up. Nobody from the Fed has ever really used it seriously. Okay, they don't talk about taper in their Fed meetings. Okay, they don't talk about tapering. It's a made up word from the Fed, from the media, to use as cutting back on bond purchases. I just prefer to say cut back on bond purchases. So anyway, any other questions? How are we doing, Jeanette? Anything you wanted to add? Any other questions from you guys? A little bit about me and about my company. I don't try and do any hard selling in these things, but I know Jeanette was going to talk about explosive options a little bit. This is a service that I got started back in May of 2011. Basically, we're long and short calls and puts. We do some spread trading. I have a special Twitter feed that I use for our subscribers only. I have a regular Twitter feed, but I also just have to send them out directly, send ideas out directly to our subscribers. I email trade ideas, quick email responses back. We have webinars once a week. We do them every Thursday. And I'll have special guests on there. I had Doug Cass on there with me a few weeks ago. And I have some really good special guests on there. I have a new chat room that we just started. I'm telling you something right now, it's just really dynamic. It's not just me talking in the chat room. It's everybody. It's a collective group of people that come in here. And I think some of you in this room here probably have been in the chat room with me before. We relaunched. I relaunched the website. We changed some things around. It's looking pretty good. And again, the webinars, the articles, the ebooks, everything together. It's all about education and helping you learn helping become better as a trader. We have a lot of fun. We're serious about trading and profits, but as I say here, I preach patience and discipline. Got to be disciplined, and you got to have patience. And it's my Twitter handle over there, Aztecs99. So any other questions? Anyone? Jeanette, I'm sorry. I think I'm running out of material here. Anybody? You want to jump in here? Or anybody else want to jump in? Oh, okay. All right. Well, I think that's going to be it for me, and I want to thank everyone for listening today. And again,
Yeah, that's fine. No worries.
I
We're real close to our next
screen,
speaker,
but I hope
so you're
you got
fine.
a good visual
You can
of
wrap
things.
up.
Jeanette, are the slides available for anybody if they want them, or do they need to contact me to get the slides, or what? Okay. And my email address
We'll
is
just make
bob@explosiveoptions.net.
we'll have them contact you for the slides, and we'll
Anything
make the audio
anything else
and the recordings available in the next couple of days
that
once
you
we
want to
have it all
cover?
published. So they can email you directly if you like.
Well, I want to thank everyone for joining in again. Go ahead, Jeanette.
Thanks, Bob. We greatly appreciate you being here, doing an awesome job, and yeah, like Audie said, just explosive presentation there. But we posted a link if you want to get more information about Bob's site. His membership available. That's available. You can click on that link, explosiveoptions.net/membership/explosiveoptionsmembership. So you see it posted as an announcement that you guys can click and take advantage of. So real quick, who's enjoying this trading marathon so far? Type in a yes. I think that we just had one of the absolute best sessions of the day right there. That should get you excited. All right, good deal. Yeah, I've been here since 6 a.m. All right. Yeah, how many people have been logged in for the entire thing so far? Yeah, you're running out of steam. Here you, Greg. So, all right, got a couple people here that are